For more on the markets and the rebound that we're seeing, let's now bring in Alan Nuckman. He's the chief market strategist at Agora Financial, standing by for us at the trading floor on the Chicago Mercantile Exchange in Chicago. Alan, always great to be able to get your views and speak with you. I want to get your take right now in terms of good afternoon. The rally that we're seeing today that started yesterday, let me first get your thoughts in terms of what sparked the rally. I think it had a lot to do with Facebook and obviously easing trading fears. What are you seeing?
Well, there are a lot of factors, but I want to go back even further than yesterday. Let's talk about how we finished strong last Thursday. Before the holiday, everything looked good. We had the markets close on their weekly highs, up a couple percent. We had long-term yields declining, which has been the issue here since February. If you look at the 10-year note, everybody was very concerned about the rising rates. We had the dollar steady, and we had the VIX go down 5 points last week, 5 full dollars. So everything looked positive until Monday. So Monday really shook the markets up. But what I find most interesting about yesterday's rally reversal rocket was the fact that we tested our recent lows. We tested and we rejected those lows. Actually, we had a higher low yesterday than we did on Monday on that major sell-off. So when we couldn't make new relative lows, you saw a lot of buyers step in, that gap was closed, and now we're off to the races once again.
So you're telling me it was a bit of a technical bounce?
I think a lot of it was a technical bounce, and I think it also has to do with what's happening here in politics in America. And you know, I don't like to talk about politics. I like to talk about price. The price action overstates what happened yesterday in the fact that it confirmed that the thinking that now when we get these announcements out of Washington, D.C., that the market digests it and quickly rejects it. And that's what we saw yesterday, that it seems to be a worst case scenario, that initial reaction, and then we realize that the markets can focus on earnings, and what truly drives the stock market is how well corporate America is doing.
Yeah, but Alan, that's the hope, right? A lot of investors, of course, want to focus in on the fundamentals and the macro picture. But then, when you hear and see the headlines and the concerns, you have to also weigh the potential of trade wars. So I'm not sure. I don't think anybody's sure, and that's why we see the volatility and all the uncertainty that the former, in terms of fundamentals, focusing on the fundamentals, is necessarily going to be the right way to invest and trade in these markets. I think it is, and that's what the market's telling us today, and we're getting more positive headlines as it relates to trade. So it's working today, but my question to you, therefore, will be, is how much of this momentum is real money? Is it sticky money? Is it just trading money? What am I actually seeing when I see a market up or making a 1,000-point swing?
Well, we've seen a lot of swings, and actually we've seen, I think, 8 consecutive days or plus or minus 1% moves in the markets. Now, let's remember that we only had 7 days the whole year of 2017. So the markets are starting to move. That is for sure. But what I'm very encouraged by, being optimistic and bullish, is the rebound action. Let's talk about yesterday. Yesterday, we had a 2% sell-off. Now, that's happened 3 times so far this year, where we've had a 2% sell-off and the market ended up closing positive. So we are getting those rebounds. You did talk about the perspective of what potentially could happen, and that's, yesterday was just a lot of the prospects of the worst case scenario, if a full-fledged trade war, and those are a lot of ifs. So I think the market's focus more on facts, and those fundamentals will start to come out here when earnings start. I think April 12th, there are big banks here in the United States. But I think I'm very encouraged by these rebounds. Now, the NDX, the tech sector, has been in the news, obviously. We had another unwind, but let's look at the facts. In 2018, we rallied 10%. We declined 10%, then we rallied another 10% in two weeks, then we fell back down. So we're essentially unchanged here a couple of days ago. Now I think we're up 4% in the tech top 100 stocks. So let's wait and see where we go from here. But, in the past, every time the stock market sold off, it's rebounded, and it's rebounded the distance of that sell-off on top of the old highs. So I'm certainly not one to say that it's over as far as stocks goes. Let's see if we can build on the momentum from yesterday, and now we'll form a larger double bottom over the last couple of months and see where the earnings season can bring us.
Yeah, and with respect to the earnings season, certainly investors are very much focused on that. What is so interesting about the earnings estimates and expectations is that at the beginning of the first quarter, the analysts were looking for about 11% earnings growth. That number is now 17%. They've essentially raised their earnings estimates on average for the S&P 500 by 8%. 4%. That's a very large move, and we haven't even seen all the benefits from the tax reform. So this could be setting us up for a whole new wave of fiscal policy moving these markets and away, and that shift that everybody's a little bit fearful of, away from monetary policy and actually into fiscal policy. And this actually maybe might be the first quarter where we're really starting to see that take place.
Right. We're seeing growth in earnings growth, which is fantastic. Now, we were double digits the last quarter, and now we're looking at, would you say, 17 or 18%? But then after the next quarter, it goes 18%, then 20%. So it's going to be a sustained earnings growth. Now, let's also remember that this is a season that's going to benefit from those tax cuts and the fact that there's going to be about $400 billion of dividends here in this spring quarter. So where is that money going to go? A lot of times it goes straight back into the market. So that could be another catalyst. And one last catalyst, since I'm talking to Canada, crude oil. Crude oil's recovered here. Another attack on that 66 high for Brent crude. And then we could be looking at 75. That's been a forgotten sector in the markets. And we're seeing a spike up here. XLE I like as a long-term value. I'm looking at January options for that. If you look at that, we're significantly off the highs of 78 just a couple of months ago in January. So look for that. XLE, the energy ETF, to catch up as we've gotten very strong once again in crude oil, and another attack on those recent highs could push that market much higher.
Yeah, I want to get your take just here on crude oil because we've seen a nice move here. What do you attribute it to?
Well, I just think the fact is that there's global growth. Until recently, we had a little contraction in the global stock markets. But overall, what's been happening, it's not just in America, it's across the world. The markets across the world have been doing very well, and we're seeing overall global expansion. And that's going to sop up the excess oil. Yeah, the story here is the North American oil, and it's not us, it's you guys too, obviously, are bringing more production online. But it's being... that demand from around the world is gonna take up that slack, and the trend just remains incredibly strong. Everybody was concerned about that additional production when we were at $35, $40, $45, $50, $55, $60. So, I think the market's fully aware that there will be more production comes online, and it's moving forward. I think the key component right now for me is the dollar. If the dollar cannot go up, we're stuck in a range between 88 and 90 for that U.S. dollar now for almost 3 months. As long as it doesn't break out and reverse this overall downtrend, remember it's been straight down essentially for the last year until this recent pause. If the dollar can make new lows, that'll be another catalyst for that crude market and give it a good kick to the upside.
Alan, just before we let you go, I'm curious, in the options market, what sectors are you seeing call options being bought? In other words, where are you seeing investors believe the market is going to move higher?
Well, that's a tough question because we've had such dynamic action here in the markets here recently. So the volatility has increased a bit, but the VIX is a very important component when we talk about buying specific options. And the VIX right now, believe it or not, has made a series of lower highs. So even though the markets seem like they're getting more volatile, mathematically, numerically, if you can just look at the number, we're here around the 20 level in the VIX. The recent highs, we've had a double top in March at 26. The highs this week were lower than 26. So even though the market's selling off, getting back down to those lows, we're not seeing new highs in volatility. So that is a very positive sign for calls in general, that it looks like we could see the VIX go down one more time, and we could see the market go up one more time.
Okay, Alan, we got to leave it there. Thank you as always.
Thank you.